$100,000 a year in dividends in just 10 years. Sounds impossible, right? Let's see how close you can actually get. Welcome to the Simply Safe Dividends channel. I'm Brian Bollinger. So could you really build $100,000 of annual dividend income in a decade? For most people, that sounds too good to be true, and in many cases, it is. But today we'll find out who this goal might actually be realistic for when the dividend snowball finally starts to feel like it's working, and I'll share an example portfolio built around this mission, including some of my favorite snowball stocks. Let's get started by crunching the numbers. I built this simple calculator that shows how much you need to save each month to earn $100,000 in annual dividends after 10 years, depending on your starting capital, your portfolio's annual return, and your portfolio's dividend yield. So a portfolio that had a 2% yield would require a $5 million balance to earn $100K in dividends. On the other end of the spectrum, if your portfolio yielded 8%, you would only need $1.25 million. I think a 4 to 5% dividend yield is kind of the sweet spot there, which would require a portfolio size of $2 million to $2.5 million. So if we started out with zero capital, we'll call this the dreamer scenario, and earned the stock market's long-term average annual return of 9% for 10 years, we would need to save between $10,000 and $13,000 every single month to build a portfolio big enough to produce $100K of dividends at that 4 to 5% dividend yield range. That's over $120,000 of savings each and every year, which is a completely unrealistic target for most Americans and shows how difficult it is to achieve a goal like this with no starting capital and just a decade of time. You would have to take more extreme measures. Maybe you think you're the next Warren Buffett and can earn a 20% annual return for a decade. You would still need to save about $5,000 to $7,000 per month at that annual return. What if you YOLO'd and found the next NVIDIA and put everything in NVIDIA, which earned a 75% annualized return over the past decade? Well, if you managed to do that, which would be incredibly risky, you would only need to save about $90 a month for 10 years to hit that $2 million, but good luck finding the next NVIDIA. So starting with nothing, it's a very hard goal, pretty much unrealistic. But what if you're a little bit further along? Let's take a look at that scenario next. Let's suppose you're a mid-career saver, perhaps around the age of 45, and you've amassed a portfolio worth $400,000 today. If you're targeting that 9% long-term market return for a decade, well, you'd still need to be putting away over $5,000 a month, upwards of $8,000 a month to get to that 100K in dividends within a decade. That's better than the prior scenario, which was requiring over $10,000 a month, but it's still out of reach for most people. Instead of a decade, let's suppose you wanted to target an early retirement at the age of 60, 15 years away. Having that extra 5 years of compounding time makes a humongous difference. Now, if you're targeting a 5% yield in the end, you would only need to save around $1,200 a month. Or at a 4% yield, about $2,500 a month. The math starts to look and feel a lot more realistic, especially once your dividends begin compounding on themselves. To make this more tangible, let's look at what happens over time. In this example, a $200,000 starting portfolio, $1,000 a month in contributions, a 3% dividend yield, and 6% annual dividend growth. The blue line represents your portfolio's monthly dividend income, and the orange line shows the monthly contributions you're making to the portfolio over the span of 15 years. Now, around year 4, you have to wait for it, but something special happens. The two lines cross. This shows you when the monthly dividend income from your portfolio surpasses your monthly contributions and your portfolio's income growth starts to become self-sustaining. Here's why that happens. Every dividend you reinvest buys more shares, which then generate their own dividends. Those dividends buy more shares again, and the cycle keeps compounding. On top of that, the underlying companies are increasing their payouts each year, in this case by roughly 6%. So you've got reinvestment, dividend growth, and time all working together. That's the point when the snowball really starts rolling on its own if you're patient enough to see it through. Now, a 6% growth assumption is also quite reasonable for a portfolio. This chart here shows the S&P 500's rolling 30-year average annual dividend growth rate going from 1990 through the current year. And you can see it's been very persistently close to that 6% level. It dipped during the financial crisis for a couple of years, but 6% is a pretty reasonable anchor to use, and it's what we're going to use now in this example portfolio. I'll be using our website Simply Safe Dividends to show you the portfolio I made. If you would like to track your own dividend portfolio and research income ideas with our platform, it's free to try. No credit card required or anything like that. I'll leave a link in the description below. Here's a look at our Snowball portfolio. It's worth $300,000. It has a dividend yield of exactly 3%, and its dividend income has grown by about 6 to 7% per year over the last decade. This is just the growth from the underlying companies raising their dividends each year. Now, the portfolio is pretty simple. It holds 25 stocks. Each get a 4% weight. I like to equal weight in my portfolio because it's very hard to know which holdings will be the best long-term performers. You'll notice this portfolio consists of pretty much all blue chip stocks that are known for generating reliable cash flow. Anything from AbbVie in the healthcare space to Chevron, a big energy giant, General Dynamics, aerospace and defense. We have Coke and McDonald's. So P&G, there's really nothing special or magical about this portfolio. It's just buying highly durable businesses that have a long track record of generating cash and returning a lot of that cash to shareholders. You can see this dividend growth streak column here shows you how many consecutive years each stock has hiked its dividend. Some in the portfolio have done that for over 60 straight years. Every single holding, though, has raised its dividend for at least a decade. And the credit ratings in here, too, from S&P show the strength of this portfolio. You can see we have a handful of companies here with AA- ratings, which is very, very strong. Our weakest holdings, just 3 of them, have a BBB rating, so 2 notches above junk status. And every name in the portfolio earns a very safe or safe dividend safety score from us. We've been doing this for about 10 years now. We have a real-time track record showing all roughly 900 dividend cuts we've seen since our business started back then. And we show you the dividend safety score the stock had before the cut was announced for predictive value. The bottom line is if investors stuck with companies that continue to maintain a safe or very safe dividend safety score, they would have avoided 97% of cuts. So I think the income in this portfolio is going to be very reliable over time and continue to grow at a nice pace. So this income forecast report will let us play with a couple of different assumptions here. If we turn on dividend reinvestment, so the dividends this portfolio throws off will be put right back into buying more shares. That's expected to give us about a 3% boost to our annual dividend growth rate. And if we enter in annual contributions to further grow the portfolio, let's say we're investing $12,000 a year in the portfolio, we can see this portfolio's income could go from about $9,000 today to nearly $90,000 in just 20 years' time. So again, the power of that dividend snowball, you can see it here through both reinvestments and making annual contributions to that portfolio. Diversification, the portfolio is very balanced despite only holding 25 stocks. You can see that no sector exceeds 16% of the portfolio's value, utilities being the biggest one at a 16% weight, those 4 stocks right there. Very different from the market. Tech is only 8% of the portfolio, where it's, I think, around 30% of the S&P 500 today. So this is a defensive portfolio that will perform very differently, especially if some wind comes out of the AI sales anytime soon. Our income stream is also diversified. No holding exceeds about 6% of the portfolio's income. So in case there is a surprise in the years ahead, our portfolio is likely to withstand that and keep that overall income stream growing. The portfolio's beta clocks in at 0.76, which indicates that it's been less volatile than the broader market as well, which makes sense given the mix of those holdings. So this is just one quick example of a snowball type portfolio, 3% yield, 6% growth, reliable, lower volatility than the market. I'll show you an example of how I picked some of these stocks that are inside of here. GPC, Genuine Parts Company, is a company that I have owned since the start of this year. If you take a look at this valuation chart on our site, it's a great tool to evaluate when to buy a stock. The blue band you're seeing is the price you would expect the stock to trade at if it was trading in line with its 5-year average dividend yield in this case. A lot of these blue chip businesses will trade at persistent valuation multiples, be it a P ratio or a dividend yield over time. And this blue band is showing you if the stock was within 10% above or below that expected level. And we can see that during 2022, the stock was well above that expected price band. It eventually sold off to get back in line. And earlier this year, when I bought the stock in January, it was trading below its expected price band, which has been a pretty good indicator over the last 20 years of good times to buy or sell GPC. If you're unfamiliar with the company, GPC is nearly 100 years old. Its business is pretty balanced between distributing automotive and industrial replacement parts. The stock has been hit by reduced activity in some of its industrial markets due to both higher interest rates and some of the economic uncertainty that's out there. On the automotive side, we've seen a slowdown in discretionary repairs as well as consumers feel the pinch of inflation. I'm not sure when those issues will end, but they don't seem like issues that will impact GPC's long-term outlook. This is a company that's raised its dividend for over 65 straight years, every year since 1957. The dividend is still well covered by earnings, with a payout ratio sitting below 60%, pretty in line with its long-term average. Earnings are expected to return to growth in the year ahead, and GPC's balance sheet remains in good shape. Its leverage ratio is about where it has been over the last decade or so, so I don't see a threat to the company's BBB credit rating. And it competes in very large and fragmented markets. I think GPC, by investing more in automating its distribution centers, broadening its inventory, it can kind of further expand its advantages against smaller rivals and play the role of consolidator in this space. So just one example of the type of snowball stocks that I like, companies that generate great cash. They've been around a long time. They sell essential parts and services and have a pretty stable long-term outlook, in my opinion, but are trading at a discount right now due to factors that I don't think will really matter or be talked about several years from now. I hope this video was an encouragement to you no matter where you're at in the investing journey. I know that rolling the snowball can sometimes feel a little bit slow and tedious, but with enough time and consistent capital contributions, it can make a humongous difference with your long-term retirement outlook, so I encourage you to stick with it. Rising dividends are one way to accomplish a snowball like we talked about in this video. If it's a strategy that you're doing now or interested in, I encourage you to check out our website, Simply Safe Dividends. I'll leave a link in the description below, but it's a really great tool to make sure that you're on track, keeping your portfolio aligned with your risk tolerance, and making sure you're just making every dollar that you've worked so hard for work just as hard for you, especially as those retirement years grow near and creating a passive source of income becomes more important. Thank you for watching this video, and I hope to catch you next time.